Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go over a concept. I'm going to explain inflation. I'm going to explain what they use to manipulate it. I'm going to explain the ramifications, how we measure these things. I'm going to use just one picture to explain all of it, at least from my perspective, and hopefully this helps you understand it better to where maybe my understanding is. Or maybe your understanding is far superior than mine, that's fine. But this is what I am going to show here is inflation and investing and what we are doing to make money. This will be a part of a training session that I'm giving Thursday, 5 p.m. Mountain Standard Time. If you're a Platinum member, I'm going to do some technical analysis training. I'm also going to go over this again just so everyone understands how this works. So let's get into it right now. What I have here is, I'm just going to make this bigger here. This is the CPI. I should say this is 3 cups. The 3 cups are 3 different sectors. One sector is stocks, one sector is bonds, and one sector is commodities. The level of the water is the money in that sector. This sector, and again, these cups I just used as a visual representation. These cups for stocks and bonds are much larger than the commodities cup. This cup here would be probably way larger than commodities. It's much larger than stocks as well. Then stocks is a little bit smaller than bonds. And then commodities is like a small little shot glass and compared to some of these bigger ones. So what I am trying to propose here is these are ratios. So if you were to do stocks divided by commodities, what it would show is that the money is in stocks. We can see that the money is in stocks by this representation, but when you look at stocks, you have to use valuations, and it's not as easy to visually represent that and show people this. So I'm using this as a representative. If the money's in stocks, and I'm just going to give an example, historically, let's say that stocks usually trade at the halfway point. That is average. So bonds are average in this scenario. Stocks are expensive and commodities are cheap. Now, the way to make money is if this money flows into another cup. So if no water is added into this system and commodities were to go up and it needs more water, what has to happen? Well, it has to take it from either bonds or stocks, which means that if water goes from stocks to commodities, the water in stocks goes down and the commodity cup goes up. Essentially, there would be no true inflation in the system. No water has been added to the system. No money has been added into these cups. Problem being is the way they measure consumer price index is measured off of commodities. Commodities like real estate, and I'm just putting real estate in commodities. Just calm down here. Real estate, and then all of the commodities that go into products. If commodities go up, the product pricing goes up. The pricing of those products. And you'll see the wave of inflation measured by consumer price index go through the system if the commodity prices, their inputs, go up and efficiencies stay relatively the same. The only way you can increase all of these cups, which is true inflation, to inflate is to make bigger or larger. In order to make a larger money supply, you must add water to these cups. They could all go up at the same rate, but the value would remain the same. So your pricing could go up, but your value against other assets remains the same. Apparently, this is very hard to figure out for most people, as I see on Twitter, people calling all of these prices a bubble, but it may not necessarily be a bubble because what they're looking at is the price of a commodity, and they're not looking at the water being added to the system. The water being added to the system also has an impact on how the money flows between these sectors. if more money comes in, people are less likely to buy bonds because it puts it into a real negative rate. It means the inflation rate measured by the CPI, which takes a little bit of time, is higher than the interest rate that's being paid on bonds. So if you dump money into this system and you dump it in every single one, you still get consumer price index inflation. You still get that. Now, here's another question. If you have shortages in commodities, if commodities are short and the CPI is measured, I'm just saying it's basically measured off of your input costs, which then flow through the commodity or through the supply chains and flown into final products that companies make. That is your consumer price inflation that they measure. But you can have the system have a problem in commodities. Money flows into this cup here, showing higher consumer price index measurements. Keep in mind, they do it this way. So one, you can't blame inflation as an increase in the money supply, so you can't blame the central banks. Two, they can manipulate these CPI numbers. That is why they use the CPI consumer price index number, because they can manipulate it lower if they like. They can print more money and manipulate it. Now, if you're in a disinflation period where you have a surplus of commodities, you can print a bunch of money, put it into bonds and stocks, and not really put it into the commodity cup. Your CPI measurement remains the same, although inflation has gone into the system. More money went into the system, but it's hidden because they're using the CPI, which is measured by the commodity inputs. If your commodity inputs don't go up, your inflation in the system remains relatively the same, or barely goes higher, depending on how much money they put in and where they put the money. But if the money goes to bonds and stocks, and they do that for a long period of time, let's say like 12 years, maybe they started printing around, just hypothetically 2009, 2010. They put all that money in bonds and stocks, and we can see that in the ratios. We can see that stocks and bonds have never been more expensive, never, in over 100 years, never, to compared to commodities. What do you think happens if commodities has a problem? What if this money, this water or money in these glasses flows into commodities? Now remember, commodities has a smaller cup. These are massive cups. Keep that in mind. When the money flows into that small cup, it can't take it. Prices go ballistic with little amounts of money. Now, if they've been pumping money into the system, lying about real inflation and showing a CPI number, well, what happens if all that money rotates back into commodities? You have a problem in the CPI numbers. And what are we seeing in Germany's CPI? What are we seeing in all these consumer price index numbers around the world? They have problems. And it started with commodities in the energy sector. It's going to rotate into other commodities. It is coming. 2023, 2024 is when the market balances go ballistic on a lot of different commodities. A lot of base metals, a lot of precious metals, a lot of different metals. Now, this isn't as simple as you think. When the money starts to flow and the consumer price index goes up and yields start to go higher, money starts to flow into commodities. It's a feedback loop. Commodities, CPI is measured there, money's flowing into it, prices go up. Pricing is going up, brings interest rates higher. Interest rates going higher brings stock flow and bond money flows or water back into the commodity cup. Remember, it's a small cup, big moves up, and it feeds on itself. So we can have a slowdown in money being entered into the system, but have a problem in energy or commodities that transfers all of that price increase into the consumer price index. I don't know how they're going to stop this. We're going to have a very inflationary period. And the money, the water in these cups is not in commodities yet. It's starting to flow. We're seeing it, but it's not there yet. It is not there yet in any sort of quantity that I think that is coming. And when these money flows start to come, you're going to see big moves in a lot of different companies because trillions of dollars have to be parked somewhere, and the commodity market's not that big. It is not that big. So, and real estate, money's going to come flowing potentially even into real estate because it has nowhere else to go. It's not going to stay in bonds if you're going to have a bond bear market for 5-10 years plus. It's going to rotate over. And stocks, we'll see what happens there. That money could also rotate over into commodities. Now, the best thing you can do is position for it. And how to position for it? What are the best ways to position for something like this that it's coming? That's what the Finding Value website training is on Thursday, 5 p.m. Mountain Standard Time. I'm going to teach fractals and Fibonacci sequences and stuff like that, looking at charts, a lot of technical analysis. I'm going to go over some ratios as well to show you what the largest potentials are based off of the cups and how they're filled. Then when that money starts to basically redistribute itself to find a market balance more towards historical norms of the psychological thresholds in the markets and where money has historically been distributed, we're going to get massive gains in those sectors. So if you guys are interested in going to that training session, it's 5 p.m. Thursday. You have to be a platinum membership. It's in the description link below. But that's what I've got. If you guys like this clip, give me a thumb up, subscribe to the channel, and we'll catch you later. This is Finding Value.